Hi, everyone, and welcome to the Strategic Wealth Strategies podcast with our host, Alan Porter. Alan, what's going on, man? How are you?
How you doing, Neil? It's a great day here in North Carolina. I thought we are supposed to get a lot of rain. It kind of cleared off. Maybe we'll get some rain later on, but every now and then I get to look out and see the Masters, so it's pretty good.
Well, that's the important thing. We're going to talk about TSR ratio today, Alan, and it's something really people should be looking into, shouldn't they? For sure, when they're with their, especially the people they're looking at financial planning and all that stuff. What a TSR ratio is.
Well, absolutely, Neil, and I would say probably 95%, if not more, of CPAs, attorneys, financial advisors, bankers, uh, they know nothing about it, and it's very, very important. And I learned this about 5 years ago from Tom Gober. Tom Gober is a forensic analyst and examiner that had a huge part in the investigation of what went on in 2008 with the mortgage fraud. And he started studying the transparency solvency ratios of insurance companies. And what he found was it's absolutely extraordinary and eye-opening for people that they need to understand, because there's a lot of sleight of hand things going on behind the scenes that people aren't aware of.
So let's kind of define what a TSR ratio is first.
Well, I may read a little bit here, but basically what a TSR ratio is, the company strength, and the lower number that you have, the stronger the company. And believe it or not, two of the lowest companies are fraternal companies, the GCU, which stands for Greek Catholic Union, and GBU. And their TSR ratios are like 45 and 50. But the well-known companies like Athene, which is one of the highest paid, what I'm trying to say, they give the highest income out. They have a TSR ratio of over 8,000.
Wow.
And the problem is, Neil, is they're transferring a lot of these assets to offshore accounts that are non-transparent. People can't see the ability. Let me read this real quick.
Mm-hmm.
The first thing to understand is that many insurance companies that were previously structured as mutual companies, which look out for the benefit of the policyholder, have turned into profit publicly traded companies. And here's the thing: as for profit insurers, they now pay dividends and focus on increased profits to satisfy the shareholder, not the policyholders. To do that, these companies have been engaging in accounting and financial transactions that free up more money to benefit shareholders. And they were doing it with reinsurance transactions that are accounting sleight of hand. And this is what I mean. Here's how it works. Instead of going to credible, independent reinsurance companies like a Lloyd's of London, they have set up captive insurance entities that only provide internal reinsurance with affiliates. Now, these captive reinsurance entities have often been offshore, but now are just likely to be set up in the U.S. But why does this matter? Why all the secrecy in captives? They need them to be secret because the transactions are accounting arbitrage. For example, an insurance company moves $1 billion of future claims off their books. Their captive takes on those billions of dollars of future claims, but they account for the costs in a way that frees up hundreds of millions of dollars, something that they're not permitted to do under state insurance statutes. Now, these claims taken off the books with captive insurance frees up more money to pay out larger dividends to stockholders, hire executive, and provide the appearance of adequate surplus. And that's just absolutely wrong. This means that many well-known publicly traded insurance companies are operating today with razor-thin edges. And it's going down here a little bit. But Neil, this is the problem with these companies. They've turned from mutual companies, now they're for-profit companies, and they're like here's a perfect example. Let's say that company A. We both have two A-rated insurance companies with the exact $10 million in I can't even talk today. They have the same $10 million surplus cushion. The substantial difference is that company A has $5 million in high-risk assets, and company B has $100 million in high-risk assets. Since company A only has half its reported surplus in higher risk assets, their TSR is 50. Company B has 10 times its reported surplus invested in higher assets, so their TSR is 1,000. So how does that affect solvency? Suppose the economy came under financial stress like in 2008, which I think it's going to come under again. I think we probably already are, and some higher risk assets become worthless. Well, company A would still have $5 million in surplus left, but 10% of company B's assets became worthless. Their supply in surplus would be wiped out. That's why the TSR ratio is so important. And that company would be taken over by the state. People don't
Crazy.
know they need
Yeah.
to.
Especially when you saw banks failing a couple years ago, right? Or a year ago, it doesn't mean an insurance company can't fail, right?
Well, here's the thing, Neil. Insurance companies are state regulated. And let's say that State Farm sells all the insurance policies in, 10% of the insurance policies in North Carolina. And some insurance companies, say Pioneer Mutual comes in and goes bankrupt in 3 years. Well, part of the premium we pay is a tax that goes into a pool of money that the state the state regulates. And if Pioneer Mutual goes under, that pile of money is will pay all those liabilities. And if anything's left over, since State Farm pays 10%, sells 10% of the policies in North Carolina, they have to pay 10% of that penalty that's left over of the assets. And if they don't do it, they can't sell insurance in North Carolina anymore. So insurance companies look out for themselves. Many insurance companies are just bought out by other companies.
Right.
But there's huge problems coming in the future. I think there's like $60 trillion in commercial loans that are coming up for maturity with nothing to back it. And you thought 2008 was bad.
Yeah.
I I don't have a good outlook for what's going to happen here.
Alan, why is it important to clients this TSR ratio?
Well, it gives them the ability to see what's out there that they don't know about. Their advisors. As an example, I had a client the other day. Well, Alan, this company, they give me more income. I said, okay, they give you more income, but what happens if they lose some of their assets? Because their TSR ratio was over 2,500, and the TSR ratio on the company I was using was 220.
Mm.
And I said, listen, I am not going to sell a policy to a client with a company that has a bad TSR ratio. Yeah, they've got a B plus or A rating on AM Best, but AM Best doesn't take into account the TSR ratio. I mean, they should, but I don't even think they know about it.
Alan, some of the companies you talk about are A minus rated by the AM Best. What about this rating?
Well, that's just it, Neil. They don't know. They don't take into account the TSR ratio. And I can give clients all kinds of you know super in the cloud predictions with the illustrations that I do, but I don't do that because I want people to understand about guarantees that insurance companies do. Now, understand this: insurance products, fixed index annuities, not variable annuities. I don't sell variable annuities because their fees are very high. They're tied to the market. And cash value life insurance, whether it's whole life or index universal life, they are the greatest financial products that are an asset class all of their own because there's no other financial product out there, Neil, that can give any of the benefits of these financial vehicles. It's in a class of itself. There's no other financial vehicle that can guarantee you income that will eliminate or mitigate the risk in retirement like life insurance products do. A stock portfolio, mutual funds, uh, money market funds, savings account, real estate, bond portfolio, all they can do in retirement is compound the risk in retirement, such as sequence of returns risk, which will decimate your retirement. People don't know about this, but they should. And their financial planners aren't going to tell them about it because I've had over 100 clients tell me their financial planner have never told them about sequence of returns risk, and they've been with them for 20 and 30 years. And these people are in retirement. They're 60 to 75 years of age. And when they find out, well, guess what, Neil? They're my clients now. But the other thing, the number one fear in retirement, Neil, is running out of money before you run out of life. That's one thing that I do. I show people how to have guaranteed income the rest of their life, even if their assets run out. You can't do that with a stock portfolio.
Right.
Again, Neil, in retirement, it's not about uh, return on your investments. It's about distribution of your assets. And the older you get with these insurance products, the higher the distribution rate is. And again, you can't do that with a stock portfolio. I
No.
mean, the differences are huge, and people need to be educated about this. But I would say probably over 95% of the people out there have no idea because they all listen to the propaganda of Wall Street that the stock I mean, a 401k or whatever IRA invested in the stock market is the absolute best thing for your retirement. You know, I've said this many, many times, Neil. A 1% fee in a 401k over a 30-year period will reduce your income by 1/3. The average fee in a 401k by lap times and verified by Fortnite Magazine across America is 2.99%. People are going to have less than half of their money when they go to retire. And then on top of that, that's net there. But on
Right.
top of that, now they got to pay 20 to over 50% in taxes.
Mm.
I mean, people they have no idea. They think they're going to have, okay, I had $1 million. I said, no, you don't have $1 million. Well, what do you mean, Alan? I had this one guy. He's a millionaire. He didn't need this IRA. He's transferring it to his grandson. I said, listen, you're in the 39.9%. This is back in 2017, 39.6 effective tax. I mean, excuse me, tax bracket. Now you've got $600,000. He said, well, yeah, that's right. And he knew nothing about required minimum distribution at that time. I said, if you don't take this, this guy was 65 years of age and had no idea about this. I said, when you turn 70 and a half, if you don't take the acquired amount of money out from that IRA, the government's going to give you a penalty of 50% plus all the taxes. By the time you have state and everything else, you'll have less than 5% of your money.
Ridiculous.
That scared the hell out of me.
Yeah. Alan, you mentioned accounting sleight of hand. What do you mean by this?
Well, these reinsurance companies, offshore accounts, they don't provide any transparency. You can't see this stuff when you audit the books, but it's out there. That's what I mean by sleight of hand.
What do you tell people that show you illustrations from other companies?
First thing I'm asking, what's the TSR ratio? Of course, they don't know. I said, well, okay, I'll compare it with what I put out. Now, your income may be higher, but I want to show you the strength of the companies because you may have the greatest income in the world, but if that company is very weak, that can go under in a year or two, or maybe 10 years down the road. That guarantee, I mean, that income you're showing doesn't mean squat.
So, thinking about this, Alan, with the market and how it's volatile and stuff, what guarantee do you get from cash value life insurance and annuities? The annuities, kind of break down annuities really quickly. So that's basically set up based on a specifically what you'll get paid out every year from whatever you put into
Yeah,
the
well,
annuity.
yeah, because they differ in range, but here's the thing, Neil. They used to say a 4% distribution rate was a safe distribution rate to last for 30 years at age 65. Well, that's down to 2.8%. And I've said this before, but let's take an example. You got $1 million in a stock portfolio at a 4% distribution rate. That's $40,000 a year. That's not guaranteed. And these fixed indexed annuities that I sponsor, you'd only need approximately $650,000 out of that $1 million to give you the same $40,000 a year, and that's guaranteed for life. And I'll have increasing income in that. And even if that accumulation value runs out in that annuity, you still have guaranteed income for life. You can't even come close to doing that with a stock portfolio. So Neil, that leaves you $350,000 to do with what you want. You can turn it into a Roth and have extra money left. And when you turn it into a Roth, there's no required minimum distribution. There's no taxation of Social Security or the means testing for Medicare Part B, which will be in the thousands per year. And people
Wow.
have no idea about this because their financial planner, CPA, and whoever they're working with have never told them about it.
So the other thing we talk about is specifically cash value life insurance, become your own banker.
Yes.
What rate do you get every year? Is there like a set rate for cash value life insurance?
Well, it's not the rate. It's not the rate you're getting for cash value life insurance. When I tell people to become your own bank, I show them how to reduce and possibly eliminate both debt and taxes, and then possibly set them up with a tax-free retirement. But what we do, I use a tax-free bucket of money and a whole life insurance policy to create a debt elimination vehicle. And it's not as fast as Dave Ramsey's uh, what's it called, snowball method.
Yeah.
The thing is with Dave Ramsey, he wants you to pay that extra money to the financial institutions where it compounds for them and not you. Now, when I found out about this, and I knew this 10, 12 years ago, people don't know what effective interest cost is. And as an example, I've said this before on our podcast, gentleman that I had, he had a 2.75% interest rate on his mortgage, but his effective interest cost was over 49.76%. And he said, Alan, how's that possible? I said, because it's not going to get down to the 2.75 until the last couple of months of the mortgage. I said, you've got great credit, but your average effective interest cost is over 49%. And it's not going to get down there until the last couple of months. I mean, excuse me, you had great credit, but your average effective interest cost is over 46%. He said, well, I said, what financial vehicle are you going to get that gives you a 46% return on your money in your 401k or anything else? He said, no, in fact, I lost 10% in my 401k last year. And he was putting $1,000 a month in it. I said, okay, let's take that $1,000 and put it in this policy for 10 years, 10 years only. Now, Neil, he'll be out of debt. He was 42. He'll be out of debt when he's 52. All right. But now with Dave Ramsey, he would have been out of debt instead of 10 years. I think it was eight years or maybe 7.9. But with my plan, in 10 years, he's got $130,000 in a tax-free bucket of money that he can use. He'll never have to go to the bank again to buy a car, repairs in the house, college education for kids, or anything else. And his death benefit at age 52 is over $400,000 to protect his family in case something happened. Now, I said, you don't have to do anything. You're debt-free. You become your own bank. Let this grow. You're done. You don't have to pay any more payments on it. And by the time you're 65, there'll be over $250,000 in that tax-free bucket of money that you can use for tax-free retirement, which I do. And I'm going to start that. I'm 71 next month. I've got 5 of these policies, and I may start drawing tax-free money from them. I don't need it, but I might do it anyway, take trips. But the thing is, he'll have a $600,000 death benefit that he can use for long-term care, completely tax-free. And people are not prepared for long-term care, Neil. Long-term care, as I've said before, costs between $50,000 to $200,000 a year. It goes up by 6% every year. And 70% of all Americans 65 and above are going to need long-term care at some point in their life.
Wow.
40% of long-term care right now, people are ages between 18 and 64. They're not prepared.
All right, fantastic. The best place to go, is to email you at we can go ahead and email you at strategicwealth0 at gmail.com and call you at 910-551-1046. Your website soon. Again, this is going to be up, and we appreciate it, Alan. Thanks again.
All right. Well, you guys have a great weekend. Okay.
All right. That was the Strategic Wealth Strategies podcast, guys. Take care.